So good afternoon, folks, and welcome to our webinar with Bhargav Dasgupta, MD and CEO of ICICI Lombard. This is part of the Kings of Capital series. Bhargav is the first non-lending CEO we are inviting Bhargav. So far, people wanted to see the lenders, but after having done several lenders, we felt that given the circumstances in which all of us are living, Tej and I felt that it would be appropriate to invite a general insurer whose health insurance policies are being procured and purchased by millions of Indians. So I'll just quickly set the backdrop. I'll introduce Bhargav, and then I'll hand over to him for his remarks on the subject. Folks, feel free to punch in your questions into the Q&A box. We've got Bhargav till 6 o'clock. Tej will curate those questions and pose as many of your questions to Bhargav in the time that we have with him. So let's make the most of it. So the reason we thought, we'll have Bhargav over to discuss his thoughts on general insurances. I think as everybody would have felt in their own lives, right? Household savings are on the rise in the last 3-4 years. This was happening even before the pandemic, but clearly the pandemic has introduced a specific layer of urgency around the way in which people are buying life insurance and health insurance. ICICI Lombard is India's largest private general insurer, and it's been a leader in this area since 2004, right? In fact, as Tej pointed out in one of the recent Kings of Capital newsletters, over FY 08 to 20, basically last 12 saal, ICICI Lombard's PAT, profit after tax, has CAGR'd, compounded at 23% per annum. And this is the remarkable part. ICICI Lombard's profit has grown at 23% per annum, even though the Indian general insurance profit pool has shrunk over that period. Quite remarkable, right? Leader growing at 23% PAT and the rest of the market shrinking. So it's great to have Bhargav here to sort of discuss quite a remarkable company. Bhargav Dasgupta is the MD and CEO of ILOM, as we call it inside Marcellus, and he's been in this leadership role since, he's been with ICICI Lombard since May 2009. His career began with the erstwhile ICICI Limited. The ICICI Bank ke pehle ICICI tha, and he's joined ICICI in 1992. He's held leadership roles across a diverse roles in ICICI Group, project finance, corporate banking, e-commerce, technology management, a subject that we will discuss over the course of our chat today. Bhargav Dasgupta holds a postgraduate degree, diploma in management from IIM Bangalore, and a BE in mechanical engineering from Jadavpur in Kolkata. So welcome, Bhargav. So over to you, sir, for your thoughts on what's happening in ICICI Lombard. How can a firm grow at 23% PAT compounding in an industry where the pool is shrinking?
Thank you, Saurabh, and thank you for having me. It's a great privilege to be here. I personally follow your posts. I have a lot of regard for the work that you guys are doing.
Thank you very much.
So I think it's interesting that you talked about the 2008 to 2020 journey. So to explain this and maybe set the context for the future, I'll talk about the industry over a slightly long shot view of last 20 years to explain the industry, probably, right? I mean, and that's probably set the context of, as I said, what we believe is happening in the future. So, this industry, while, it's quite a large industry, it's almost 2 lakh crore premium is what we earned as an industry last year, is relatively understood. Possibly because the industry, we were the first company got listed in 2017. Before that, there was not too much of a spotlight on this industry. And from the point that you're making about personal interest in insurance, it wasn't something that people woke up in the morning to think about buying, right? It was not one of your priority items that you thought of buying. So it was relatively under-researched and under-understood industry. And that's probably the reason why I wanted to kind of give you the long shot view to extend the journey. So this industry was opened up for private entry in 2001. Before that, it was 4 government companies which had 100% of the sector control. And that year, about over the 2 years, 2000 and 2001, about 8-9 companies came in. But till 2008, which is why that year becomes important in the analysis. Till 2008, the pricing for the industry was tariffed, and this is typical global practice. In general insurance, a lot of countries at a stage of development would tariff their premiums because it's a complex business. Let the government set the price. So we had a tariff market in 2008, and in 2008 the tariff it was de-tariffed except for one line of business, which is motor third-party liability. The rest of it was all got deteriorated. Now, what happened post 2008, when the detariffication happened, was that a lot of prices really crashed in certain lines of business. Prices crashed by, I mean, you won't believe it, by more than 90%. In general, prices crashed by about 30-40%, and it stayed low for roughly about 9-10 years till 2018, I would argue. And then gradually prices started going up. Why does this happen in general insurance? And this is typical trend wherever you see in the world when the sector is opened up, where it is detariffed, prices come down and then it starts picking up after 4 or 5 years. Because this is an industry where there is no concrete cost of goods sold. So you may write a policy, there is no claim, you make full premium, right? And there's natural optimism that people have in the right policies, and that's the mistake that people make. I think the biggest focus that biggest learning for GI companies is that the underwriting aspect, which is use data, analytics, predictive capability to price the risk well and then manage the risk well, is an important element of success. And unfortunately, for some time, I think a lot of players in the industry never focused on that. For us, that was a big focus, from the 2008 onwards period, because prior to that, prices were very rich. It was tariffed. That wasn't a priority. But as prices crashed by, as I said, on an average 30-40%, we had to do that. Now, as I said, this industry is less understood. So one way of looking at this industry, it's an insurance industry, which is a risk management industry, and it is a risk management industry. The other aspect of this industry is that it's a float industry. So what happens in this industry is that you get the premium upfront. Claim may happen, during the policy period, which is over the next 1 year, which is traditionally what the premium duration is for general insurance. But in certain cases, as in motor third-party liability for us, claims may happen after 6-7 years, because the Indian law says that, or till about a year and a half back, said that a third-party claimant can intimate a claim anytime in his lifetime. So while you're driving the car, you have an accident, you will take your car and get it repaired immediately. So you'll know the claim immediately. But a pedestrian that you hit on the road can decide after 10 years that, I got injured and I have all the proof, I will claim now. So the tail, as we call it, of claims are very long. And the accounting regulation in India is that you hold reserves on a predicted basis for a claim that may have happened at that point. You don't even know about this, right? You'll know about it 10 years later. But using statistical models, using actuarial models, you hold a reserve on a nominal basis. So if the claim today is, let's say, worth 100,000 rupees, on an average, our model shows that the claim duration is about 6-7 years and inflation is double digit. So 200,000 rupees today will become 200,000 rupees 6-7 years later. And you hold a nominal reserve of 200,000 rupees. In a sense, different from the typical lending industry approach, right? You don't upfront the future NPAs in that manner. So it's a very conservative reserving and an accounting model that we have in India. When you do that, it depresses your profit for the period.
Absolutely, and depresses your ROE.
It depresses and book value, capital, and also it creates a float, because you're sitting on this money for 6 years, right? And if you manage that float well, which is why I call it a float management business as well, you can deliver a good return on equity, relative to some of the other players. So if you see, for us, the last 13 years that you talked about, we've had a CAGR of about 23%. Largely because, if you look at our investment float to net worth is roughly about 4 times today. It was less earlier. And we've delivered about 8-9% return on that float. And if you run your investment book, the insurance book at a reasonable cost of that float, as in the underwriting losses are not very high, you can very easily deliver that ROE. So that's the fundamental model. Now, also to step back and explain the structure of the industry, other lines of BFSI is, as I said, more understood. Everyone is looking to save money. Everyone is looking to buy a car. Everyone is looking for a gain in the stock market, investing in mutual fund. So again, at an individual level, also you understand and connect with that industry a bit more. Now, this industry is in a sense a unique, industry within BFSI, where we don't compete with any other part of the industry, BFSI sector. So a mutual fund and a life company may be competing for the same savings pool. A bank and an NBFC is competing for the same, asset customer. We don't compete with any other part of the BFSI space. So that's another reason why probably the sector is relatively, in a sense, isolated, but it also creates an advantage for good players in this industry, because you're competing within your sector with your, competitive set. And if you now look at the structure of the industry, as I said, when it started about 4 PSUs, multi-line general insurance companies. There were 8 or 9 of us who came in 2008-9. And that's how the structure of the industry was till roughly about 2007-8. And then a bunch of companies started coming in almost every year. 1, 2, 3 companies would come in. Today we have 34 companies. The last set of 4 odd companies came in 2017. Since then, there's not been a new entrant in this industry. And within that, that cohort of about 34 odd companies, I would put them in 3 buckets, let's say. One is the PSUs, bit challenged now because of the aggression of the 2008 to 2018 has kind of hurt their balance sheets. Solvency is under pressure, so they need capital infusion, from the government, and there's been a talk of government infusing capital, but there is only a limit of how much capital can be infused. The second is, among those original 8-9 companies, there are 3 or 4 companies which I believe have built a sustainable business, and then there's a long tail of small, more recent companies will come in. Some of them have done well, but not all of them have done well, and they're kind of in a small, kind of competing at the edges. So our sense is that this industry is kind of getting rapidly consolidated, and I think this COVID impact is probably going to be felt even more in terms of driving towards safety and quality and scale, going ahead. And some of these better players will gain a larger share of the profit pool of the industry. So that's the, in a sense, a bit of a maybe 30,000 feet background to the industry. And coming to your point on what we think will happen sector by sector. So, in terms of growth, the first 8 years when the pricing was, as I said, tariffed and it was reasonably rich, the industry grew at about 17% CAGR in those 8 years. If you see the next 13 years, and that includes last years of almost single digit growth, the industry has grown at close to 16% CAGR, about 15.8%. Now, if you take out that 5% growth that we had last year, it's again close to 17% growth, CAGR, 16 decimal point CAGR growth for the industry. So, in spite of price correction that I talked about, this industry has continued to grow at that pace.
Right.
And that's largely driven by the clear change in mindset of customers, which is what you were trying to, you were starting with, in terms of what are we seeing in terms of customer, changes in customer, insights and behavior. Clearly, I mean, if you asked me 6-7 years back, health insurance was a push sale, right? You had to go out and convince people that you need to buy a health insurance. And by the way, another interesting statistic, if you look at the total healthcare spending in this country, roughly 2/3 is out of pocket, about 63, 64. I mean, this number, changes a little bit here and there, but ballpark about 2/3 of it is out of pocket, which means government doesn't pay for it, insurance doesn't pay for it. If an event happens, you sell assets or take loans from or take grants from family members, and or you're saving, dip into savings and take care of the bill. If you see global benchmarks, this is like the least developed countries. This is sub-Saharan Africa, right? This is really poor. I mean, 62-63% is very, very low. Most countries would have 70-80% paid for by either insurance or government provided healthcare. So that itself is creating a pool for health insurance. An event like this, unfortunate event, but makes people realize the importance of protection. Similarly, for motor insurance, what we understand is that based on data that over the last 3-4 years is now coming together, where the central government has created a centralized database of registered vehicles on the road, which we didn't have something like this a few years back. And the insurance industry has created a registered database of insured vehicles. We are seeing more than 50% of vehicles on the road flying without an insurance. Now, large proportion of that may be two-wheeler. Mm-hmm. And it's typically that, and by the way, again, it's a law of the land that you have to have a third-party liability insurance when you're driving a vehicle, but in spite of that. And again, that's changing. Supreme Court passed some judgment which will change it. I think compliance is changing with more digitization, more data, and more availability of these cross linkages between industries' databases for the police system also to catch people without insurance. So some of these things are changing. Similarly, what we're saying, if you look at the other two components, so if you look at our industry, there is motor insurance, there is health insurance, there is corporate P&C, typical property and casualty that globally is seen as the big part, and lastly crop. And crop, I won't spend time. We don't write crop, but rest of it P&C again. Huge amount of under insurance. if you see this time when COVID happened, globally there was a big debate on should insurance pay for, this non-damage business interruption loss. What insurance industry pays traditionally is for if there is a natural calamity or a fire or a flood in your premise, because of which your business is interrupted, we pay for the damage to your property as also the loss of revenue, right? Minus your cost, etc. So that is called business interruption cover. Now, globally, there are non-damage business interruption covers which are popular. So you don't have to wait for a damage to your property. Maybe for some other reason, you have to stop, not something that you could control. Then the industry would pay for the BI claims. Now, that problem didn't arise in India because no one had those. Those products have never been popular. Liability insurance, directors and officers liability insurance, it's quite shocking how many of the listed firms don't even have D&O policy. I'm just giving some, anecdotal, examples. So sector by sector, there is a huge under-penetration. And if you look at the aggregate number, every sector in India is under-penetrated. So when you throw a global number, it may not be relevant. But if you compare with China, China's insurance density is $200 per capita. We are $19 per capita. That's how stark it is.
Wow. 1/10 of China.
1/10 of China in terms of insurance density per capita insurance premium.
So, Bhargav, the recent upsurge in interest in health insurance and the whole upsurge in interest in protecting one's family. Do you reckon this will pass when COVID passes, or do you think this is here to stay? It's a structural shift. Is there any way to get a grip on how long this interest sustains?
So I'll tell you what we saw last year, and that probably reflects the mindset, right? What we saw last year is that the demand for health insurance started picking up from April, May, and reached a peak in Q2 of last year. And then it started tapering off. And that, in a sense, probably partially answers your question. The elevated demand that we saw, I mean, these were, very rapid growth times, 50-60% growth in that period. Suddenly dropped to but didn't drop to the original traditional level that we used to see. So my sense is that whenever there is a crisis, there is a demand for insurance that picks up, but it also lifts. There's a structural shift up in terms of the aggregate demand that it creates. So this is the kind of growth that we are seeing today may not continue next year, but relative to what we saw 2 years back, there is a structural increase in the demand for health insurance. Anecdotally, what we are seeing is, one, people who never had health insurance are, of course, buying more. But what is even more, I think, personally interesting is, till about 2 years back, we used to go out and tell our customers that a 5 lakh insurance cover is nothing today. I mean, you go to a hospital for 5 days, you'll spend much more than that in the big cities. So we used to try to tell them, and we've had situations where a customer with has a Mercedes but has a 3 lakh insurance. Right. So what's the value of a 3 lakh insurance for a Mercedes, driver? So that segment, I mean, we had almost 30-40% of those, customers saying, can you upsell me or can you give me a 10 lakh cover? I have a 5 lakh cover, give me a 10 lakh cover. So there is definitely a shift in terms of demand for higher sum insured that has happened. And I think that's a structural shift, because once you bought a 10 lakh cover, you're not going to go back to 5 lakh cover. But it's also increased the demand for health insurance as a category. Now, as I said, it may not remain at that same elevated level, but relative to what it was, there is a structural increase.
And just to sort of flip the question on its head now, there's a lot of our clients ask us that, look, you have ICICI Lombard in the Kings of Capital portfolio, but hey, won't there be a deluge of COVID claims that will take away whatever premiums they're writing? Is there a way for you to statistically model what the incidence of claims will be? I know it's still, we don't yet know fully whether third wave will come or not, but is there any way to model this?
Look, we do model it, and not to say that the model is perfect, because this model, no one gets this model right, is our experience. Having said that, I'll tell you what happens for us, right? So if you look at the health insurance pie, for us, we are a slightly smaller share of health insurance compared to the industry category. So industry has standalone health companies which are only health insurance, right? And they have a larger piece of the health pie. If you look at the overall industry construct, we have a relatively lower share of health insurance. Within health insurance, there are, let's say, 3 categories. One is the social insurance, where we don't play, which is the government-funded insurance schemes, where we don't have any exposure. Its premium is inadequate. The second is the employer-employee, which is the corporate sector buying policies for their employees, where we have a normal market share. We have slightly less than a normal market share, but we have a reasonable market share. The third is retail, which individuals buy insurance, right? And within that, there are two categories. One is benefit plans. These are, we call them benefit plans. These are basically fixed benefit plans for specified diseases. So these are critical illnesses. Let's say you buy a cancer policy, or you buy a policy which covers, 33, high cost procedures, illnesses which lead to high cost. Let's say, a renal failure, or a cancer, or or a CABG, heart, etc. So some of those things, but they pay only for those 33 elements. It doesn't pay for generic hospitalization. So they are called the benefit policies. And the other category is indemnity policy, which is, as the word indicates, it indemnifies the cost that you incur in a hospital. So that covers anything that, for whatever reason you may be in a hospital for, we will cover it, including for COVID. So now for us, as ICICI Lombard, as I said, our retail health portfolio is slightly small for a historic reason. We can get into that if you want to. We are building it out, but still, it's we have a 2 to 3% share in the market share, unlike our 7% market share overall. And within the retail health, we are much more, or we have traditionally been a much more of a benefit company and a less of an indemnity company. So for us, it's not a big problem. For the industry, for the standalone health companies, this is definitely a big problem, because no one anticipated this, no one priced this. In some of the markets like US, Spain, Australia, insurers have basically said this pandemic was an exclusion. We will not pay. Government is paying for this healthcare cost.
Wow.
In India, as an industry, we are bearing this cost. The other thing that we see when this COVID happens is, again, from a portfolio perspective, we have motor, other policies, etc. Motor claim ratio comes down, and health goes up. And within health, the medical management or the elective surgeries go down, and only the COVID hospitalization goes up. So on balance, we
are actually better off from a claim.
We are actually, unfortunate to say that as an insurance company today, but it's just so that it so happens, given our portfolio mix, that we don't have any worry on the COVID. Standalone health companies would have a big problem.
So just to now move away from COVID and health and think more structurally, right? I suspect in circles like ours and the people who are attending today, right, affluent people on Zoom, Marcellus clients and so on, I suspect the penetration of your products is already pretty evolved, pretty mature. It's the smaller towns and cities, and perhaps the lower income strata. Can you give us a sense of how quickly or not the penetration there is coming through? There must be a way for you to measure that, given how much technology you guys have. Is the penetration story, that 1/10 of China story, is the remedy of that? Is the remediation of the 1/10 of China story working out, or is it Tej Shah and Saurabh Mukherjea are buying more and more ILOM products?
You would be surprised, Saurabh. So yes, intuitively you would think that everyone here has adequate insurance cover. Right. The fact is, in this period, the number of my acquaintances and friends who reached out asking for enhanced cover has been remarkable.
Wow.
And people have, as I said, a health policy from their corporate, company provided health policy. People think that's good enough. They don't worry about it. So people are now buying top-up covers. I have a 3 lakh cover from my company. Let me buy a policy which has a 3 lakh deductible, and I buy a top-up cover above that. That's one. Secondly, if you look at traditional insurance or health insurance anywhere in the world, you will find that health insurance pays for the entire continuum of care, from your dental expenses to a visit to a dermat, to a visit to a GP, your pharmacy bills, everything is covered in insurance. And if you think about the total cost of healthcare, the hospitalization cost, which is the only thing that we pick up, is again roughly 1/3 of the total healthcare spends in the country. So we have not even touched that 2/3.
Right.
We're only focusing on the sliver of the IPD, which is a healthcare cost in a hospital, and within that there is an underpenetration because of under-insurance. People have insurance, but it's under-insurance compared to today's cost. So to me, the opportunity across strata is significant, both in terms of full coverage, and there's a reason why as an industry we couldn't cover outpatient and all these dentistry, etc. At a stage of evolution that we were, if you increase the premium, the attractiveness of the product comes down. So, you have to, for some time, maybe give a restricted product and, make people consume part of it. And then then people come in and understand the value of the product and it increases. Number one. Number two, controlling abuse outside a network hospital in a OPD setup is tremendously challenging. Even in a hospital, it's a challenge. Outside, it is even more of a challenge. And we couldn't do it unless we build a tech, platform which created an ecosystem, which we've now done. I mean, as ICICI Lombard, we've created one about a couple of years back. So that's how we are going into that segment. So to answer your question, that segment is also underpenetrated. But your larger point about the rural market, we are still some way away, is my sense. I mean, there is clearly an increase that we are seeing. So, for example, one of the things that we did about 2-3 years back was we set up these virtual offices, which is no branch office with a sales guy with a tech stack, basically working off distributors' offices and homes. So as to keep our costs down. We have about 840 of those. We set up a bit more than that, but some of them were underperforming. We need out. Now it's about 840. And we'll invest again in the next round in that. But that 840 is last 3 years growing much faster than the rest of the business.
Right.
But on a small base. So we still have a long way to go in the rural markets. But again, this event has probably changed perception a bit.
So what you're saying is that the big metros plus say the district towns will still be 90% of your your business, right?
Exactly.
Now this technology piece, right? In your career, long career, I noticed in ICICI itself, you've done a technology role, and your tech savviness has obviously been the firm's tech savviness has been very prominent. I think many of in the pre-COVID world, many of us took Ola or Uber cabs, where part of the prompt was, do you want to insure yourself for this journey, courtesy ICICI Lombard. Now, this aspect of bringing technology to insurance, in a way, what Bajaj Finance has done in the NBFC world, and arguably, and this is a non-ICICI company, what HDFC Life has done in life insurance, you guys have done in general insurance. Where did the impetus for this come? And how materially do you think this contributes to that 21% ROE that you guys are able to post, which is the best in class number? So tech, inspiration, and contribution to ROE, please.
Okay, so inspiration, honestly speaking, if anyone as a group, as a financial services group was the leader in tech, was ICICI, right? Maybe some parts of ICICI has fallen behind, but if you go back to the early days of ICICI, sorry?
The first ATM in the country, you guys came.
Yeah, exactly. I mean, first, online banking was again, ICICI Bank. So anyway, so this has been part of the learning as part of our development, right? I remember when Mr. Kamath was running ICICI Bank, he used to believe that business managers should think of themselves as technology managers. And that's very progressive thinking from those days' time. And personally, I thought that thought process appealed to me. But there's a context, right? I mean, if you look at a GI business, as I said, in 2008, prices dropped by 90%, right? And I'll give you just two statistics, and then I'll talk about some of the sectors. So if you look at ICICI Lombard in 2008, we had roughly 18,500, a bit more than 18,000 FTEs. FTEs doesn't mean agents. I'm not including agents. Full-time employees, maybe employees or contract staff, who are working full-time for us. A bit more than 18,000. Cut to today, we have a bit more than 10,000 plus. Our business has grown 5x. Our policy count has grown about 8x in this period. Now, we had to do this because when prices correct at the level that it did, you have to, kind of squeeze water from stone, right? Because you have to keep your cost under so much of control to be able to survive, in that environment. Now, initially it was cost and convenience, and very rapidly we realized the value of digital data. And before I go into digital data, I'll just give you one more example. So, for example, in 2012, we started focusing on building up our two-wheeler insurance business. It was there. It was not that we were not writing, but it was not scaled up. And the conventional logic in the industry was that two-wheeler insurance is unviable because, a 700-800 rupee policy. Imagine issuing a policy, right? You'll eat 50% of the cost into the cost of servicing the policy. So you can't think of running that business if you don't completely digitize the process. So we said, okay, let's think of doing this differently. and we tied up with petrol pumps. Again on an iPad or a laptop, someone on the ground was issuing a policy while you're filling your bike. That was our promise. Before you can fill your bike and pay the bill, our insurance policy will be issued. And it is non-trivial in terms of trying to do this in a remote area because of connectivity challenges, etc. So there's a lot of things that we have to do to even build some of these businesses. Coming to your question on what it does today, the way we look at it is that of course the cost, convenience, all that is par for the course. But the biggest advantage today is because we've digitized over the years. Today we are able to think of digitizing at the next level, but more importantly, the data that we've created over the years is to us one of our biggest advantage. So I'll give you one small example. So when you have a motor policy and you forget to renew the policy, right? What do we do traditionally as an insurance company? We send a surveyor to check whether there is any damage during that period. So suppose your policy was due on 1st May, you woke up on 15th May and said, no, can you give me a policy? I want to know that you didn't have an accident during this 15 days, because otherwise you'll be, gaming me, right? Mm-hmm. So what do? We send a surveyor to check whether the car is damaged or not. We were working on a virtual inspection process, right? Using your tablet, you could do normal claims adjudication. We don't not necessarily send a survey. You do your survey using your phone. So we said, now we've got a lot of images and a lot of data, right? And in any case, we had started tablets-based surveys from 2012 onwards. We have a lot of images of damaged vehicles. So we use that to build an AI model to allow people to do the inspection of the car. Just take 8 photographs and we guide the person, and the AI engine figures out whether there's a damage to the vehicle or not. It saves us cost. It's great convenience. Similarly for health, I'll give you some example of COVID. So if you look at the InstaSpec data, which is the virtual inspection, this is not the break-in survey is a different part. The virtual inspection, we were doing about 25% of the cases in March before COVID, March 2020. Exit last year, we were doing about 60%.
Wow.
That's the kind of progress that we've seen in 1 year. Some of it being forced, and it's just a great opportunity to push these tech stack.
Efficiency gains presumably are here to stay.
These are here to stay. And I'll give you one more example of health, for example. So we use data of the past to authorize health, approval, authorization to the hospital for our group customers without any doctor intervention. Earlier, doctor would say the case file and say, okay, it's authorized, you can start. Today we do it, through a AI and ML engine. Again, the number was 30% pre-COVID. The number is about 65% today. That's the way it's scaled up. Now, this we couldn't have done without the automation and the digitization of the past, because we had the data of the past to build these engines. And if you can keep on working on this engine and build on it, which we obviously are doing, we're kind of building on each of this, I think it becomes tougher and tougher to play a catch-up game.
Right. So you're saying the data that you have, your competitors don't have, right? As a result, your underwriting is better, your claims ratios are better, superior, your profitability improves. You then you invest that money and earn better and better returns.
That's the thought process. Now it's the execution issue thereafter.
So I'll hand over to Tej now. Before I hand over, I'll give you an anecdote relating to motor insurance, and this will explain one of the reasons why I migrated to India. So when I was 18, I took my dad's car. I was insured to drive that car, and I drove it into a rubbish truck. Right, this was in England, and the car was a write-off. But the consequence of that was, for the next 13 years in the UK, I paid very high insurance policy rates. Right, so by the time I left the UK, my annual motor insurance premium was more than the value of my car, right? God. So when I came to India, nobody asked me this question, right? Did you wreck a car in the UK? So I still benefit because no motor insurer asks me about my wreck as an 18-year-old. And that's a huge privilege of living in this country to get motor.
So insurance drove you out of UK. That's interesting.
Tej, over to you.
Yeah, Tej.
So on this topic, we've got a few questions on what do you make of the new digital or online only general insurers which have come in over the past 4-5 years. Will they be able to transform this industry over the next decade or so?
Yeah, I think that's a good question, and I think we should pay some attention to this, because if I look at this, when I played the story about the history of this industry. From 2007-8, bunch of companies kept coming in till 2017. There's no new company that is coming after 2017. Except for one company, everyone till now has had a Me Too strategy. Me Too strategy in the sense that go to the same channels, with the same product, proposition, and try to compete with the established players, which, you can figure out what the consequence of that is.
Yeah.
Today, there is only one company, and there are many companies which talk digital, but today only one company is trying to be completely digital, right? There is some other companies which say that they're digital, but they're exactly in the same dealerships, exactly in the same, channels, doing reinsurance, doing crop, everything else, right? Now, I've always said that, let's look at the two new companies. One is digital completely, the other is digital, but doing things that the way that everyone else is. And I've always said the company which is doing the things that everyone else is probably will initially have a better success, because today it is, and I'll explain the industry structure. Today it is very difficult for a pure play digital company to come in and compete in a meaningful way today. Now, that doesn't mean things won't change over 10 years. So if I look at a differentiated strategy, as I said, only one company has come up with a differentiated strategy, and that's trying to build a pure play online business. Now, why do I say it's a tough ask? Because we've been, also we have a digital business from 2004-5. We started issuing policies back then. We, about 2.5 years back, we carved out our digital division into a separate, we call it a company within a company. We call it Digital One, which has a separate board, separate HR policies, separate structures, separate team, which is engineering, actuarial, underwriting, everything separate, right? So we try to create a company within a company. So we kind of have the experience of running a digital business. And the cost of digital, so what happens in India? So when you buy a car, the first policy that you buy, it gets sold to you from the dealer. Typically, you go to a car, they will give you a list price. In the list price, there will be a line item which says insurance, and it will usually be one invoice. You won't even realize that it's a separate piece, and the dealer will say, "Don't worry, I will take care of all the convenience, service, etc. So if a claim happens, just call me." It's very convenient. So almost entire fresh policy sale happens in the premise of the dealer. And the dealer does a lot of hard work to retain that customer for a couple of years, right? And then maybe after 2-3 years, the customer, then is, the connect with the dealer reduces. He's also willing to get his vehicle repaired in some other, smaller garage. He doesn't need to go back to the same dealer. But the first 2-3 years, he's very, passionate about his car. He doesn't want to go to a small shop. He goes to the same dealer. So there's a very strong bond. After 3 years, so that is when the insurance bond also breaks. You start, researching online, maybe buying from an agent, etc. And then after another 2-3 years, you buy a new car. Traditionally in India, typically 4-5 years later, you buy a new car. After 5 years, you buy a new car, and you go back to that same cycle. So that's the structural challenge for a pure play digital company on motor side today. On the health side, because let me complete the thought process. So when you procure a customer online, the first year, it takes 2 to 3 years to break even, because there's a huge cost of sourcing the first year, and then you have to kind of defray it over a period. So that's the only challenge that pure play digital has. And now with this Supreme Court decision, which is, in my opinion, a very, very positive decision because of the under penetration point that I made. So with two-wheelers, it's 5 years. So the TP policy is anyway out. Even if you're coming in after 3 years, you're only going for the OD policy. And similarly for private car, 3 years as TP policy is out, you're only going for the OD policy. So now you're chasing an even smaller pie as a digital player, because the TP policy has anyway gone with the first year. Coming to health needs a tremendous amount of engagement. And as of now, I have not found anyone, including us, we've not cracked the code of complete online. So all of us is basically doing assisted online. The customer come in somewhere, a telephone will happen and we'll close the sale. And there's a fundamental reason. We do a lot of research with customers. There is a reason why customers need some amount of personal advice. It's a very advisory model as of now on health insurance, and the indemnity part, which is a big part of the health insurance. So those are the two big retail pieces. The one thing that can go online, which has already gone online, is travel, but it's a small piece of the market.
So I think this is just worth elaborating. What Bhargav is saying is, because the Supreme Court is mandating that at the point of purchase, you have to have 3 years of third-party cover. And at the point of purchase, typically all of us, when we buy new cars, the showroom is basically selling the policy to us or intermediating the policy. Therefore, the online guy gets cut out of that. The online manufacturer gets cut out of the action. And in that regard, the Supreme Court's diktat allows the conventional incumbents to enhance their position, enhance their market share to the detriment of the online challengers. That's a very interesting point, actually. Tej, back to you.
One of the questions we've got is on the investment side. So you talk about risk management, underwriting, but investment is most as important function, especially for a general insurer in terms of float management. How is it that ICICI Lombard over its almost now 20 years not seen even a single write-off on its investment?
So I guess we've been a bit lucky. So if you look at our investment asset, so today it's roughly about 31,000 crores. Roughly about 80% is in bonds. Typically it ranges between 85 to maybe 75 in that range. Roughly 80-81% is in bonds, of which a large chunk is in government bonds. Even from a regulatory perspective, 30% has to be in government bonds. And rest of it is in corporate bonds. And as of now, about 12-13% is in equity, and rest we keep in some alternate assets and largely liquidity, even 5% in largely in cash for claims, etc. So the approach that we've taken, because the bond book is the material part of the book, equity we have another strategy, and thankfully we've done reasonably well. But on the bond side, if you make mistakes, it's a big cost, right? So our approach has been that we take duration calls, we take interest rate calls, we take a view on interest rate. We do that, and we've done that over the last 20 years. We always take duration calls using government securities. We never take duration call using corporate bonds, because that's not worth it, right? So anyway you're taking an interest rate call, so we focus use the government securities. On the corporate bonds, when we invest, we do not invest below AA. We typically invest AAA and AA plus, but we do not invest below AA. And even AA is a very small component of our business. And we do not invest based on credit rating only. We of course look at credit rating, but that's not the only filter that we look at when we are investing in corporate bonds. Now, why do we do this? Because, and this is based on data and research, but our strong conviction, the investment team has been there with us for 20 years, and and they're originally from ICICI, so we've seen the credit market. Data shows, and our experience says, that the risk premium that the market gives for lower rating is not adequate for the incremental risk in India. So what I mean by that, if you are getting 6% for a AAA bond, and you get 6.7% for a single A, that 0.7% is not adequate for the risk, the risk premium that should be there for the difference in rating. That's our point of view. And secondly, secondly, as I said, we don't just look at the rating, company. We have been in the sector, so we have a way to sense whether we trust the management, the governance, etc., and we play safe. And what that has done is, as you rightly said, Tej, we've not had a single corporate bond which has defaulted in our history, and we've not had a single corporate bond which has even delayed interest payment in our history. And I think it's just, we believe that playing safe on the bond market it's a much more value-creating strategy over long term. And if you look at our investment portfolio, including the equity and the overall portfolio, over the last 20 years, we've returned close to 10%, about 9.7, 9.8% return throughout this history.
Right. One of the questions is around the recent acquisition. Could you share what is the thought process, what went behind this acquisition in terms of, was it financial metrics, in addition to that, the distribution which the new acquisition would give out? And historically as well, you evaluated a health insurer also in the past. What is it which goes behind the decision of finally pulling the trigger?
Yeah, so you're right. I mean, we've looked at the way we've looked at M&A has been, there has to be some amount of complementarity, or because of the synergy, we add some new distributor, and also the synergy benefit plays out in terms of creating value for our shareholders. So we've looked at many transactions in the past. I mean, there are enough transactions in the market float around, and most of them typically come to us. And in the past, I think it was in the papers, we looked at one health insurance platform very, very, very closely. But someone else were willing to pay more than what we were willing to pay, and that's why it didn't happen. In this case, it was in a sense a one-to-one conversation. It was a curated transaction. So what happened, early days of the COVID lockdown, is that our call was that this industry will consolidate further, and the big will become bigger and stronger. And this was ripe for consolidation. When we look at consolidation, there is, of course, the new capabilities that you can look at, let's say a pure play health company, or you look at a mid-size company which you can integrate and create value. So when we look at this entity, Baji, if you look at this company, it was set up in 2007-8, but for the first 5-6 years, it had a mixed experience in terms of what they delivered. And then they had a change in management about 4-5 years back. A new team came in, and we saw that they were doing a bunch of good things. I mean, in terms of building out the right distribution, tying up with the right, bank assurance partners, building the base for, a value creating business. But they were subscale, 3,200 crores of premium. The investment that they were making, it was difficult for them to deliver a profitability. So if you look at the 2020 numbers for them, which is what we saw when we looked at the transaction, their loss ratio was 78%, expense ratio is 42%. And a lot of it is because of the subscale nature. And the other thing that we did look at in this case was a lot of, in a sense, the governance related issues. We liked their accounting, their reserving, their culture, good bunch of people, good team. And that's why we said, and it was kind of a reasonable size. It was not very large, not very small. So it was right in the sweet spot in a sense, and that's why we looked at this transaction, because the 42% expense ratio, obviously when you come together, you'll save a lot of unnecessary money that they were spending.
Just to quickly ask a question on that. So Bhargav, there's actually a lot of literature in academia, and there are plenty of case studies done on your sort of industry, that this sort of industry necessarily ends up being dominated by one or two, maximum three players, right? So one of my professors in college, a man called John Sutton wrote a famous paper in 1992 that any industry where intangible assets, intellectual property, and intangible assets is a critical driver of success, you will end up with a two-player industry. Now, if you guys genuinely have superior data and better underwriting, and you are combining that with superior skills in managing your float, you presumably end up doing a really good job. Does that therefore imply that through your efficiency and competitive strengths, and perhaps through such future acquisitions, you end up consolidating this industry?
It's a possibility. I mean, I'm not saying that we are, kind of thinking about our M&A, every waking hour. So our thought process is that, right now, this transaction is awaiting the final approval. Once that happens, we've done a lot of hard work in this, 8-10 months in terms of preparing for the integration. Whatever is legally allowed within that bounds, we've prepared for it. And I think the next 12 months will be execution. And we want to ensure that what we had assumed in terms of our, synergy advantages, both in the revenue side as also in the cost side, we are able to actually deliver. So that's the focus. Having said that, we are very open. As we've always said, I think this industry will. You're absolutely right. We believe. I mean, I'm a bit more generous. Maybe 4 or 5 companies. What I've been saying, that we'll end up with 4 or 5 companies which will capture most of the value. And you could wait for others to consolidate. Companies don't die in India, right? So something happens, right? They get bought out, they get change of management. Maybe a PE comes in when the current shareholder struggles to provide more capital, and more capital coming in creates unnecessary pressure in terms of competitive intensity. And as it consolidates, it becomes a stronger and more robust industry. And the industry is also able to invest and serve customers better. So it will happen. The question is, do you want to be a moving force behind it, or do you want to play on the side? We believe as a leader, it makes sense for us to play a more active role.
Right. Tej, back to you.
Few questions around, because this has become more competitive in terms of, as an industry, in terms of pricing recently on the motor side. Do you see competitive intensity on some of the motor TP is tariffed, but on the motor OD side, increasing of late from the private general insurance space? And do you think that this is something which has happened in the past as well? Therefore, it is sort of cyclical and competition comes and goes away, and you'll be able to manage segments.
So your voice broke for a second, Tej. I understood the question as, do you see pricing correcting in OD? And this has been a pattern in the past. Sometimes competition intensity increases, and whether it will settle. Yeah. Okay. So to look at it again from a kind of a long horizon, from 2008 onwards, we've seen the cycle play out many times. I mean, before we were listed, it was not seen by the market, but we've seen players coming in, particularly in 2007, 8, 9. There were a bunch of players that came in. And the initial strategy for most of them was to get very aggressive in the motor side, because it's the easiest segment to focus on, right? To build. It's a largest segment in the industry, and you can go to a dealer and throw some price or commission dolly, and you can get some business, right? So we've seen it many times. And whenever this happens for 2 to 3 years, these companies gain a bit of market share, then struggle, because it's not a sustainable strategy. And at least our approach has been, while it's a franchise, we don't want to let go of a franchise. So we stay invested in the dealership. We, kind of balance our portfolio during those times. And we believe, in a sense, like, on the investment side, you should be contrarian. Even in the business side, if you can, you should be a bit more contrarian. That's what we've been trying to do. Now, more recently, last 2 years, I would say pre-COVID, there was clearly a pressure that was being felt in the industry, and our sense is that market would have started repricing a bit. We were starting to have those conversations, and then because COVID happened, and frequency of claims did drop, right, because of the lockdown, etc. There was no need for a price increase, and it's a competitive industry, right? If there's no need, the prices won't go up. And again, by the end of last year, the pressure was building up. We as a company had actually told quite a few OEMs that we are going to increase prices next year. We did do some tweaking here and there. And then again, the second wave happened. And again, the same story has been played out. My sense is that when things normalize, we are hoping, no one knows, that the third wave won't happen. But moment things normalize, there will be a tremendous pressure for price correction. And this is a typical cycle that we see in the industry, because for quite a few players, particularly on the health side, they will have some challenges this time round. This wave is much worse than the first wave. And then on top of it, if the motor side doesn't support, it will be challenging for some players.
Right. And on this, you've historically been able to switch segments, whether it be exiting out of crop or entering into fire recently. You've been able to switch segments pretty quickly. How is it that you've been able to spot these ROE generating opportunities across these segments, while most other players, they've not been maybe so nimble?
I guess it's to do with the maybe the mindset or the incentives. I mean, question is, what are people being measured on, and what organization capability have they built? First two, I don't want to comment, but if you see the organization capability, one of the things that we do as a company is our underwriting, sales, actuary, our finance, and we sit together with our motor portfolio every month. Right, and we review the portfolio and discuss calls, and we take calls which is more from a sustainability perspective. That at the end of the day, if you don't deliver a reasonable ROE, there's no point doing that business. But these are franchises, right? So you have an agent who's giving you that business, or a dealer which is giving you that business. So you don't exit that franchise. where we do take calls, like as an example that you gave in crop, that's not really a franchise business in the sense it's a bidding business. Every year, if you have the capability, you bid and you go and win that business. So there you can take a more binary call, right? But for franchise business, you have to take a very calibrated call. What I mean by a calibrated call is that you say that, okay, this particular distributor, I will reduce my market share to 10%, but I'll stay invested. Now, so that's what we do. And the challenge is for the team, because, we can decide that in sitting in corporate office in Bombay, but for the team, it's definitely very challenging. But I think that's a cultural thing that that's got built over the years, because people know that we will focus on profitable business. They know that we don't want to vacate a relationship. We value a relationship with a dealer or distributor like anything. So we have a frank conversation with the dealer saying that this is my problem. Most times it works. Sometimes it doesn't work. Most times it works.
So just to sort of take a cue on that, Bhargav. So, one positive way to look at ILOM, and in a way to think about ILOM, is maybe a significant part of ILOM's success and the very impressive ROE and the PAT growth that we discussed at the outset of the conversation. The ICICI Bank, the might of ICICI's distribution might, has rubbed off positively on you guys. The company that you're acquiring, for instance, didn't have that sort of distribution. Most of your rivals don't have that sort of distribution. Now, credit to ICICI Bank for building ILOM, but ILOM clearly benefits from that. How much of your success do you reckon is because of the distribution might of the ICICI banking machine?
Look, at the beginning, first is the brand, right? I mean, the fact that we have the ICICI brand itself is a huge positive for us to build, and there's enough research which says that in India, financial services brands usually do well in other adjacent financial services business. Right? So that itself is a big, big positive. So, that's one. The second is, of course, people culture. Largely we benefited from that right in the beginning. Third is the point that you're making. The initial foray. I mean, if you look at ICICI Lombard, we started largely with corporate business. We started writing motor much later, and that also we leveraged the bank's OEM relationship to get an entry. Right. So you're absolutely right that we benefited tremendously from the bank's presence, particularly in that point in time. Bank was very strong in the retail asset side, right, and in terms of the auto loans, etc. So any dealer would know ICICI Bank, and we had a advantage. But over the years, that's kind of now thereafter you have to build on our own. So, for example, the agency channel is unique to insurance, right? That's not something that you can build from the ICICI Bank platform. Bank assurance, we had the advantage of ICICI Bank, but because of ICICI Bank, we couldn't go to other banks till some time. Then gradually people began to trust that these guys are trustable, so I can give them my bank insurance business. So that's changed over the years, but initially that was a bit of a challenge. So we had a tremendous advantage today. That if you look at our share of business that we get from ICICI Bank, it's now down to 6-7%. Right. And the distribution channel, for example, the two-wheeler, where we built a dominant presence, we've kind of helped the bank go in there, because two-wheeler lending wasn't a big piece for the bank. So now it's, the parent advantage, of course, remains. There's many benefits that we get, but it's not as much as in the beginning.
So last question, Bhargav, before you go. The typical person listening in today, I reckon the typical person listening in today will have an income of around a crore. Right now, we do position sizing as fund managers, but honestly, we have no idea how much should somebody earning 1 crore in India, how much health cover should that person buy, right? And honestly, even I do it on guesswork. So some professional input for everybody listening on how much health cover should the sort of people who are listening in, suppose they're earning 1 crore per annum, how much health cover should they buy?
So I would I would say that profile of your investors here should buy a deductible plan. A deductible plan is not a grounds up plan. A deductible plan is to say that your first, let's say 3 or 5 lakh, you'll pay out of your pocket, and then buy a 1 crore cover, at least a 50 lakh cover, right? Because and if you really want absolute peace of mind, buy a cover that covers for global treatment and go for a few crores, 3-4 crores, right? Why do I say first deductible? Look, I think anyone who's earning 1 crore can spend 2-3 lakhs in a crisis, right? Not a big deal. But if you do that, your cost of insurance really comes down.
Right.
And the other thing that you should buy increasingly coming, as I said, it wasn't there in the market, is the outpatient cover, because there is tremendous aggregation benefit that we get as an insurance player when you buy outpatient cover. This is not there in the market, not very popular. Some of us have launched it, but it's not very popular. But buy a top-up cover with the first deductible and a OPD cover, which takes care of your regular doctor visits and all these other things.
Yes.
Because there's a tremendous benefit that you get in terms of cost saving.
I'm glad I asked the question. I learned a lot myself. Thank you very much, Bhargav. This was fabulous. We'll continue with our clients with some housekeeping work. Thank you, sir. We learned a lot.
You.
Best of luck in growing at 23% PAT, because we have a vested interest in that.
Thank you. Thank you so much, sir. Thank you for having me. Bye-bye.
So Tej, over to you.
Yeah, sure.
Tej, you might want to switch off the camera, because I think there's a bit of low bandwidth at your end. So you might want to switch off the camera, especially since you'll be projecting as well. So folks, we'll focus today, Tej will focus today on, in the last month or so, data has come through on how quickly the Kings of Capital lenders are growing in spite of the mayhem that we've seen in the broader country. So we'll focus on the growth rate of the lenders and why we remain convinced that these lenders will carry on doing very well in spite of the second wave. So over to you, Tej.
There are 3 factors which drive the growth of the Indian lending industry. The first factor being that the Indian banking sector usually grows at a multiplier of the GDP. So historically, over the past 10 years, we've seen that the Indian banking sector grown about 2 times GDP growth. This again can be divided into 2 phases, up to 2014, up to 2015. The growth was about 3 times. However, over the past 3-4 years, because of a variety of factors, including asset quality review, IL&FS crisis, the Yes Bank DHFL crisis, demonetization, over the past 5-6 years, banking sector credit growth at a sectoral level though has slowed down. However, on average, if you look at it on a cross cycle basis, across multiple cycles, from a 10-year perspective, in Indian banking sector credit growth is usually around 2 times of real GDP growth. The second factor, which is an additional layer of growth on top of the banking sector growth, is that private sector banks grow at a further multiplier of the banking sector credit growth. So in Kings of Capital, we have not invested in any public sector lenders. We have invested only in private sector lenders. Therefore, this is very relevant for the Kings of Capital portfolio. So in addition to the real GDP growth multiplier, there is a 1.75 times multiplier for the private sector banks. So if you look at the chart on the right of the screen, we've seen that banking sector credit growth, while it has been much more volatile, it has been impacted a lot because of the asset quality review and then demonetization and the Yes Bank crisis. We've seen that even during the past 5 years, the private banking sector credit growth has been around the 19-20% mark. Because India's public sector banks still account for 60-65% of the market, we've seen that the sector credit growth over the past 5 years has slowed down. But because for us, the more relevant metric is the rate at which private sector banks in India have grown. So even during the past 5 years, where the macro was challenging, especially for the financial sector, we've seen that credit growth for the private banks was at around 19-20%. And this is largely because of market share gains from the PSU banks. So we've seen that only over the past 5 years, we've seen that market share of private sector banks went up from about 25% to 40%. So straight 15% jump in market share over the past 5 years. In addition to these 2 factors, we've seen that even within the private sector, there are a select few players who are able to rapidly benefit and rapidly grow their profits from this unique opportunity. So we've taken the examples of HDFC Bank, Kotak Bank, Bajaj Finance, which are able to disproportionately benefit this unique opportunity that the Indian banking sector provides. The opportunity being, first of all, India, because it is a developing economy, credit is underpenetrated, it is a credit-starved economy. The banking sector credit grows at a multiplier of real GDP. Second, because private sector banks still account for only 30, 35, 40% of market share, they grow even more rapidly than the banking sector credit growth. And within the private sector, we've seen that the success of these players depends on three things. One is all lenders have a high reinvestment rate. So we've seen HDFC, Kotak, Bajaj Finance reinvestment rate consistently in excess of 80%. Second, when these lenders reinvest capital, they reinvest along with the equity capital, also leverage, which is raised on top of the equity capital. So for example, if say a lender earns a profit in any given year of 100 rupees and 90% is the reinvestment rate, say 90 rupees will be reinvested in the business. In addition to the 90 rupees of equity which will be reinvested, because lenders are a leveraged business, they'll also reinvest. Say if a lender is leveraged 10 times, they'll also reinvest 900 rupees of debt into the business. So not only is there a high reinvestment rate in terms of equity, but there is a further reinvestment of debt on top of that equity. Secondly, on top of that, these lenders generate a consistently high return on assets. So on the total amount which is being invested by these lenders, debt plus equity, they are able to consistently generate return on assets. They are able to do this because of a variety of reasons which we have highlighted earlier. Say Bajaj Finance, HDFC Bank, because of their superior technological and big data capabilities. Similarly, Kotak Mahindra Bank, because of its superior capital allocation capabilities, has been able to consistently generate return on asset in between 2 to 4% on this high amount of reinvested capital. And the ultimate result of this is the chart on the right of the screen. That over the past 15 years, we've seen that HDFC, Kotak Bank, or Bajaj Finance, they've been able to consistently grow profits at 20, 25, 30%. So the factors which these lenders have benefited from are high reinvestment rate, ability to leverage on the higher reinvestment rate by raising external capital at lower cost of funds, and thirdly, by generating consistently high return on assets on this reinvested capital. Coming to growth during these challenging times during COVID, we've seen that on quarter-on-quarter basis, over the past
Tej, your voice is breaking. So why don't you stop projecting? I'll project. So perhaps that will help your voice come through. Perhaps if you stop projecting, it'll use. Yeah. So I'll just do the projection. So that way, perhaps we can save some bandwidth. Just give me 1 minute, and I'll beam up the slides. Here we go. Yeah. So back to you, Tej. Tej, can you hear me?
Yes.
Okay. I think we've lost. You can see the slides, right, Tej?
I can see the slides now. Yes.
Yeah. So just carry on. I'll try to put this in show mode. 1 second. Yeah, just carry on with the projection. I'll try to put this in show mode.
Yes. So coming to the growth in Q4 and Q3, we've seen that during the lockdown, the lenders in our portfolio had become conservative. That slowed down growth because there was lower visibility on cash flows of their borrowers. There was lower visibility on how the COVID impact will eventually pan out. However, especially during the December and March quarters, we're seeing that the lenders have started accelerating growth. So growth had normalized in the December quarter, and they're actually above pre-COVID levels in terms of quarterly Q1Q growth by the end of the March quarter. So while the industry in the December quarter was growing at only 10%, the KCP lenders were growing at almost twice that rate of 18%. During Q4, again, the industry, we believe, will be growing at only 10-12%. But the lenders in the Kings of Capital portfolio, they've grown at around 27-28%. So this market share phenomenon, the gaining market share, the kings of capital lenders gaining market share, this is something which is likely to continue over the next 3-4 years. And the reasons for this market share gains are pretty obvious. These are lenders which are well capitalized. These are lenders which have excess tier 1 capital. And these are the lenders which have provided well for the COVID NPAs, which will come through. Not only the first wave, but also partially for the second COVID wave NPAs, which are likely to come through in the coming quarters. And these lenders are likely to grow at the 20% plus mark over the next 3, 4, 5 years, just like they had grown before COVID. These market share gains are likely to accelerate in the coming few years. Saurabh, could you move to the next slide, please? Yeah. When we look at the balance sheet position of these lenders, we are able to see that the NPAs increased from about 1.7, 1.8% before COVID. So in the December quarter, the NPAs for the portfolio at a median level were around 1.8%. Despite what was expected of COVID, that there will be a huge surge in NPAs, we've seen that the NPAs have been pretty manageable. NPAs are at only about 2.5%. On this marginal increase in NPAs, the provision coverage ratio has come to now about 80% for the lenders in our portfolio. Before COVID, this was about 50%, and now it is at about 80%. So despite the increase in NPAs, despite the increase in provision coverage ratios, we are seeing that the tier 1 for the lenders is now higher than what it used to be before COVID. The tier 1 capital for the lenders in our portfolio now stands at around 21%. This number used to be at around 18% before COVID. And this is the reason why the lenders in our portfolio will be able to absorb any additional NPAs which will come through because of the second COVID wave. And also in case there is a third COVID wave, these lenders will be able to absorb those sort of NPAs and then will be able to recover and lend whenever the credit demand recovers over the next few quarters. Finally, coming to performance, we launched in July 2020. So it's been about 9-10 months since we launched. These are numbers in absolute terms, 24% since inception. Versus about 45% for the Bank Nifty. And the reason that there seems to be a large difference between the Bank Nifty and the portfolio is that the Bank Nifty consists only of banks. It consists primarily of 5 banks, 5 banks being HDFC, Kotak, Axis, ICICI and SBI. These 5 banks form about 90% of the Bank Nifty. Versus in our portfolio, we have about 35 to 40% in non-lenders, the likes of ICICI Lombard, HDFC Life, a couple of other players. And we also have NBFCs. If we were to compare the performance of lenders versus the Bank Nifty, we are at around 40 to 43% versus the Bank Nifty is at about 45-46%. However, because since we launched, since July, the non-lenders in the portfolio did not see a large drawdown due to the first COVID wave. They were actually beneficiaries of the COVID wave, just like we heard from Bhargav how ICICI Lombard has actually benefited from COVID. There was not a large drawdown in the non-lenders. So the non-lending piece of the portfolio has delivered around 9-10% sort of a return, while the lenders have delivered almost similar returns as the Bank Nifty. And that is why it currently looks like there is a big difference between where the Bank Nifty is versus where our portfolio is at.
And folks, one of the reasons we thought we should invite Bhargav is so that others also appreciate why it's worth having a financials portfolio where 40% is non-lenders, right? Why run a Kings of Capital portfolio where we have the best life insurer, the best general insurer, the largest asset manager and the largest stockbroking player? Because the savings theme in India is incredibly powerful, as those anecdotes Bhargav gave about 1 and 2 drivers not having a third-party cover, about the health insurance penetration being 1/10 of China, even though our per capita income is only 1/5 of China, but our insurance purchase, health cover purchase is 1/10. So there's a massive story there on savings which is playing out. In fact, all of us this evening are part of the savings story. Why else would you guys be listening to a presentation by a PMS provider? We want to play that. It gives us solid compounding. ILOM's 23% PAT over a 13-14 year period where the insurance profit pool shrank is great proof of that. And remember the Marcellus obsession. What is our obsession in life? We want to help our clients compound consistently at 20-25%. Honestly, other than these presentations, I don't even know what the Nifty has delivered or the Bank Nifty has delivered. It really doesn't form too much of our thinking. Underperform kar rahe hain, outperform kar rahe hain. Our goal is to put on the table as consistently as we can across all our various products a 20-25% return. And we think having a financials portfolio which is 60% high quality lenders, 40% savings plays, gets us to this number of 20-25 with a very high degree of consistency, which is why we are very happy with the portfolio and have no reason to change it. We'll be happily underperforming any index you give us for the rest of our lives if we can keep gunning out 20-25%. So I'll stop the sharing here and go back. Let me just take a few questions from the questions you guys are firing, and we'll try to do justice to that. And hopefully it'll give you a sense of where Kings of Capital is going. By the way, assets under management in this portfolio now are significantly north of 400 crores. And as Tej says, we believe the next 2-3 years will bring plenty of good news here in terms of underlying EPS compounding. What the stock market will do, we don't know. At many levels, we don't care. What we try to specialize in is what will the investee companies do. So let's take a question that Sanjeev Gupta ji is asking. So he's asking us, how much conviction do you have? And Tej, you'll have the privilege of answering this question. How much conviction do you have that HDFC Bank will become a 1 trillion company in 10 years? So it's today around 104 or 105 billion. So Sanjeev Gupta ji is asking, what conviction do you have, Tej, that will give you 10x in 10 years?
Yeah. So, like we showed, there is enough room for a bank, say like HDFC Bank, to keep on going for the next 10 years. So, runway for growth is immense because, like we showed on the slides, first of all, GDP growth in India is in real terms around say 4, 5, 6%. On top of that, there is a multiplier say around 2 times. Banking sector credit growth, it grows around 10-11%. And the private sector banking credit is around 14-15%. Despite the past 20 years of compounding by HDFC Bank, despite it growing at 20-25% over the past 20 years, it still has only a 7-8% sort of market share in the Indian banking industry. So runway for growth is immense. In terms of whether it can take away market share from the rest of the players, because 60-65% of the market is still controlled by PSUs, we believe that the PSU banks, because they have only said 10-11% capital adequacy, they're starved in terms of capital.
So let me just take it there because I think Tej's voice is breaking. What Tej is trying to say is that if you look at the well-run private sector banks, they're normally able to grow their loan books. The overall private sector lending book in totality grows at around 2x GDP growth. So if GDP growth in our country, nominal GDP growth, this is say ends up being 7-8%. Tej, you're losing your voice. You might want to see if you can log on because you're losing your voice. So private sector bank loan books should grow at 2x GDP. So private sector bank totality 16-17% should be doable. HDFC Bank consistently gains market share. You can see that over the last 12 months. Over the last 12 months, RBI has said 5-6% credit growth in the country. HDFC Bank credit growth has been 17-18%. So if HDFC Bank consistently gains market share, even in the context of private sector lenders, it should be able to do 20% loan growth compounding. Profits grow a little faster than that. You should be ending up seeing 20-23% profit growth. And Sanjeev ji, even if you assume no re-rating, de-rating, profit growth of 20-25%, loan book growth of around 20% should get HDFC Bank to that $1 trillion number. Tej was saying HDFC Bank's market share is all of 6%. Just imagine, created in 1995, today 6% market share, $105 billion market cap. The public sector banks account for 60%. Imagine the growth runway therefore for HDFC Bank. I think there's another question by RK Gupta ji. He's saying, hi Saurabh, I think he's referring to ILOM. ICICI Lombard, one of the best companies in general insurance, growing at 24% CAGR, growing PAT at 24% CAGR. But why is the same not reflecting in the share price? Why has the share price just doubled in the last 4 years, right? So I think that's a happy situation, Gupta ji. We as investors in ILOM are buying lots of it, and we obviously will carry on buying it. Tej, if you can hear me, do you want to comment on why ILOM has just doubled in the last 4 years in terms of share price?
Yeah. Am I audible now?
Yeah, you're audible now.
Okay. So over the past 4 years, we've seen that ICICI Lombard has continued to deliver 20% in terms of return on equity. Profit growth also has come through. And we've seen that this has happened with other companies as well. Even in the financial sector, say HDFC Bank's example, if you were to take, there have been periods where the share price performance is not exactly in sync with profit growth. However, if we were to take a longer time period, and we have seen that happen with all our portfolios, including when we have backtested the Kings of Capital portfolio as well, we've seen that more than 80 to 90% of the share price is attributed to earnings growth. So the differential in share price growth and profit growth usually over a period of time is minimal. It is very unlikely that a company continues to grow profits at around 20% and its share price compounding would be, say, at 10%. So we believe that the gap between profit growth and share price growth over a period of time usually narrows down. It's a matter of time that happens.
Now Hari Kalyan asks a question which I think he's asked it in the context of ICICI Lombard, I think, but I think it's relevant for the rest of the Kings of Capital portfolio as well, including the lenders. So Hari Kalyan is saying, as Warren Buffett remarks, if insurance is more of a commodity, how do you differentiate from the rest of the competition to earn profits? Is it through premium sales, through investments, or anything else? I think perhaps you intended the question to be asked to Bhargav. So I think it's worth explaining how firms like HDFC Life in the context of life, ILOM in the context of general insurance, and say Bajaj Finance in the context of NBFC, how these firms are building quasi-monopolistic businesses where it's very difficult for others to compete with them on an even footing, and why the perception that it's a commodity is actually just that. The reality is these firms are on their way to building incredibly powerful long-term growth engines. I'll just beam up the ILOM ROE numbers whilst you talk, Tej. Over to you.
From the outside, it looks like there is not much of a differentiation when we look at, say, ICICI Lombard or any other general insurer, because eventually what they are selling is a simple insurance policy. Similarly, if you look at Bajaj Finance, all they are giving out is a simple loan which any other lender which has capital on its balance sheet can give out. However, the biggest differentiation between a Bajaj Finance or a HDFC Life or an ICICI Lombard versus any other player in the industry is their investments in technology, big data analytics, and the way that they think about the next 3, 4, 5 years. It is pretty easy for an NBFC or a bank to give out loans to a salaried employee or even to a self-employed individual. However, the difference lies in whether they are able to build competitive advantages over a long period of time by building either big data analytics platforms which have big data and analytics attached to them, or by building large databases where they capture data and they are able to predict whether in the case of ICICI Lombard there will be any adverse claims in the future. In the case of Bajaj Finance, whether the NPAs are likely to rise by giving a loan to a specific individual. Because these companies started doing this, ICICI Lombard, say, Bhargav explained, started doing this 4, 5, 6 years ago. Bajaj Finance had started doing this 5, 6, 7 years ago. Because they are well ahead of competition in terms of building data analytics and big data capabilities, these are the companies which keep on incrementally benefiting from the big data and analytical capabilities. So if you were to take Bajaj Finance's example, because it already has a database of about 5-6 crore individuals in India. It is able to lend to these individuals much better than any other NBFC in India. Because it is able to select individuals which are the least likely to default over the next, say, 1, 2, 3 years, its big data capabilities and its database keeps on improving even further. So for any other competitor of a Bajaj Finance, ICICI Lombard or HDFC Life to play catch up incrementally keeps on becoming more and more difficult. So from the outside, it looks like these guys are doing something which is completely ordinary, which has a lot of competition. However, when we look at returns on equity of these players, we're seeing that on the screen. The returns on equity are 20% or 20% plus, because they've invested in intangibles like big data analytics and predictive capabilities, which other competitors have not been able to do.
So folks, this point is actually really central, right? The whole rise of big data, AI, ML, the application of AI to big data, and the virtuous cycle that it creates. 20 years ago, that wasn't there. So if you look at why Warren Buffett made so much money in Geico, and he's still invested in Geico. So it's, in any book on Buffett, you will see that in 1952 or 53. He invested in Geico. He turned it under, when Berkshire Hathaway took it over 10, 15 years later, they turned it around and Geico became one of the most profitable insurers. That dynamic, the traditional Warren Buffett ka float wala discourse, turning around loss-making insurers, turning them profitable, making a lot of money. That was around sensible underwriting, judicious, prudent underwriting, and sensible reinvestment of the float using Buffett's investment acumen, right? That dimension's been there, and even through the 80s, 90s, smart insurance executives knew that if they were judicious, conservative in their policy underwriting, and wise in their investments, they could build a profitable general insurer. Last 20 years, and especially in the last 10 years, the additional dynamic that has come in is the ability to use data and AI to build massive barriers to entry. Right, so Admiral in the UK. So Rakshit and I, when we were in the UK, we used to cover Admiral. Admiral in the UK pioneered it. Right, they were born around the turn of the century, and by 2006, 7, 8, he was a massive player. He was one of the largest insurance underwriters, motor insurance underwriters. So from scratch in a decade to building a giant insurance business using online and conventional, but very clever underwriting using उस जमाने का big data, turn of the century big data. Firms like ILOM, firms like HDFC Life, we reckon are doing it at another level. And this self-reinforcing spiral is very powerful. That's why we were asking Bhargav whether he'll become a consolidator. And I think politely he told us he will. And therefore we stand to make a lot of money as ILOM goes on to monopolize the insurance industry. It's very, very difficult to see why in life insurance and in general insurance, 10 to 20 years out, we won't have, far fewer players than we have today, and why well-run, efficient franchises like HDFC Life and ILOM won't make lots of money for Marcellus and Marcellus's clients. So I think we'll leave it at that today, folks. Thank you very much for joining in. I hope you found the session useful. We'll keep trying to bring these sorts of CEOs to you. And I think in our other portfolios as well, the same initiatives are underway to bring to you the great promoters, the great CEOs who drive compounding, who drive wealth for our clients. We are basically just custodians of your money. The real work, the real brilliance is 30 management teams who run India's best businesses. So you'll see more emails from us going out to you, inviting you to join more such webinars with India's best CEOs. Thank you very much for joining us today. Take care, stay safe.